Money impacts almost every decision we make, from the food we buy to the lifestyle we live. Many people earn well but still struggle financially because they lack basic knowledge about managing money. This video explores 10 financial concepts that everyone should know to take control of their finances, build wealth, and avoid common mistakes. By applying these concepts consistently, you can create a secure future, reduce stress, and reach financial freedom faster than you ever imagined. These ideas aren't just theory, they are practical tools you can use every day to improve your financial health. Budgeting, the foundation of financial control. Budgeting means planning your money ahead of time so that you always know how much is coming in, going out, and where it should go. It prevents overspending and helps you prioritize important expenses over unnecessary ones. The 50-30-20 rule is a simple framework: 50% for needs like rent, groceries, and bills, 30% for wants like entertainment, dining, or hobbies, and 20% for savings and investments. Tracking every small expense, like your daily coffee or subscription services, reveals hidden leaks in your finances that add up over time. Budgeting also allows you to set clear goals, like saving for a vacation, emergency fund, or a new car, and ensures money is allocated toward those priorities. Digital apps and AI tools can automate tracking, categorize expenses, and give insights into spending habits, making budgeting easier and more precise. Reviewing and adjusting your budget monthly ensures that it aligns with your income changes, new expenses, or evolving financial goals. Even small, consistent changes in spending habits, like cooking at home instead of eating out, can free up hundreds of dollars every month. Emergency fund, your safety net. An emergency fund is a financial cushion for unexpected situations like medical emergencies, car repairs, sudden job loss, or home maintenance. Without an emergency fund, people often resort to high-interest loans or credit cards, which can trap them in debt. Ideally, you should save 3 to 6 months of living expenses, but if your income is unstable or you have dependents, aim for 6 to 12 months. Keep the fund in a high-yield savings account so your money grows slightly while remaining easily accessible. Treat your emergency fund as untouchable except for true emergencies. It is the foundation of financial security. Regularly contributing even small amounts can grow your fund faster than you think. Consistency is more important than large one-time deposits. Having an emergency fund reduces anxiety, allowing you to focus on long-term goals without fear of unexpected setbacks. Credit score, your financial reputation. A credit score is a numerical representation of your financial reliability and is checked by banks, lenders, landlords, and even insurance companies. A high credit score ensures lower interest rates, easier loan approvals, and better financial opportunities. Your payment history plays the biggest role. Paying bills late can significantly harm your score, while timely payments improve it. Credit utilization, the ratio of credit used to credit available, should ideally stay below 30% to maintain a strong score. The length of your credit history and having a mix of credit types, like a mortgage, credit card, or auto loan, also impact your score. Avoid frequent credit applications because hard inquiries can temporarily lower your score. Regularly monitor your credit report for errors or fraudulent activity, as even small mistakes can affect your financial reputation. A good credit score saves you thousands of dollars over time through lower interest rates and better financial opportunities. Debt management, understanding good vs bad debt. Not all debt is harmful. Good debt, like student loans, mortgages, or business loans, can help you build long-term wealth if used wisely. Bad debt, such as high-interest credit cards, luxury purchases, or loans for items that don't increase in value, can drain your finances. Paying more than the minimum balance on loans reduces interest payments and helps you become debt-free faster. Prioritizing high-interest debt first can save a significant amount of money over time. Tracking all your debts and creating a repayment schedule gives clarity and control over your financial obligations. Avoid impulsive borrowing, only take loans for necessary, productive purposes. Consider consolidating multiple high-interest debts into one lower-interest loan to simplify payments and reduce costs. Managing debt effectively allows you to focus on building wealth instead of being trapped in financial obligations. Saving vs investing, know the difference. Saving is setting aside money for short-term goals, emergencies, or predictable expenses in safe accounts. Investing involves using money to grow wealth over time by buying assets like stocks, bonds, ETFs, or real estate, which have growth potential but also some risk. Savings provide security and peace of mind, while investments allow your money to grow faster than inflation. Balancing saving and investing ensures both present financial safety and long-term wealth creation. Even small, consistent contributions to investments compound over time, resulting in significant wealth in the future. Diversifying investments across different asset types reduces risk and increases chances of steady growth. Saving for short-term goals keeps you prepared for immediate needs, while investing focuses on future financial freedom. Combining both strategies creates a strong financial foundation and allows for flexibility in achieving life goals. Compound interest. The real wealth builder compound interest is when your money earns interest on both the principal and the accumulated interest. This creates exponential growth over time, especially when investments are consistent. For example, contributing $100 monthly at an 8% average annual return can grow into a substantial sum in just 10 years, with most growth coming from interest rather than initial contributions. Starting early is crucial because time amplifies the effects of compounding. Regular contributions, even small ones, allow compounding to work efficiently and grow your wealth faster. Avoid withdrawing money unnecessarily, as interruptions slow down growth. Using retirement accounts, dividend reinvestment plans, and automated investment tools can maximize compounding benefits. Inflation. How it affects your money. Inflation is the gradual increase in the cost of goods and services, which reduces the value of money over time. If your money isn't growing, it will buy less in the future, making planning for long-term goals challenging. Investing in assets that grow faster than inflation, such as stocks, ETFs, or real estate, protects wealth. Diversifying investments across multiple asset classes reduces risk and helps maintain purchasing power. Keeping excessive cash idle in low-interest accounts means your money is losing value over time. Understanding inflation helps you plan expenses, savings, and investments more effectively. Planning for inflation ensures that your future wealth can support your desired lifestyle without compromises. Assets and liabilities. Know the difference. Assets are items that put money in your pocket, such as rental properties, stocks, businesses, or savings that generate interest. Liabilities are items that take money out, like loans, credit card debt, and purchases that do not generate income. Tracking your net worth, assets minus liabilities, provides a clear picture of your financial health. Focusing on acquiring assets rather than liabilities helps build wealth over time. Avoid lifestyle inflation, which occurs when your spending increases as your income rises, slowing wealth accumulation. Smart decisions, like buying income-generating assets or avoiding unnecessary debt, accelerate financial growth. Consistently increasing assets while minimizing liabilities creates a path toward financial freedom. Retirement planning. It starts now. Retirement may seem far away, but starting early makes it easier and reduces stress later in life. Contributing regularly to retirement accounts, pensions, or other long-term investment plans ensures a secure future. Low-cost index funds or retirement-focused portfolios provide steady growth over decades. Increasing contributions as income rises accelerates wealth accumulation. Early planning allows for flexibility, letting you retire comfortably or pursue other passions without financial worries. Retirement planning also protects against rising living costs, healthcare expenses, and unforeseen financial challenges. Consistent contributions and disciplined investments allow your money to grow through compounding and smart asset allocation. Financial independence, your long-term goal. Financial independence occurs when your money generates enough income to cover your living expenses, allowing you to live without relying on a job. Building multiple income streams, saving consistently, and investing wisely are essential steps. Controlling spending and minimizing liabilities help reach this goal faster. Achieving financial independence provides freedom to pursue passions, spend time with family, or explore new opportunities without financial constraints. It reduces stress and gives peace of mind, knowing that you can maintain your lifestyle regardless of external circumstances. Combining financial knowledge, disciplined action, and patience is the ultimate strategy to achieve independence and true wealth. These 10 financial concepts are simple but extremely powerful when applied consistently. Budgeting, saving, investing, managing debt, understanding credit, and planning for retirement create a strong foundation for financial security. Starting small and acting consistently allows you to grow wealth steadily over time. Knowledge alone isn't enough. Taking action, staying disciplined, and reviewing your finances regularly ensures long-term success. 2026 and beyond.